story.
Welcome back. We just told you that the Reserve Bank has given different provisioning requirements for large NBFCs, actually large housing finance companies, under its scale-based regulations. RBI has said that large NBFCs, upper layer NBFCs, must set aside 1/4 to 2% of the loan amount for standard assets as provisions. And then it goes on. For teaser loans, you have to set up a higher amount, like 2% provisioning. We are joined by Mr. V.S. Rangan, Executive Director at HDFC. Mr. Rangan, good morning. Thanks much. What is the provisioning now for a teaser loan? And it's, I believe, increased to 2%. What's it now?
Good morning, Lata. Actually, this provisioning requirement has to be seen in two parts. The first part is that the standard asset provisioning, which are applicable to HFCs, not only now, but even the earlier regime and post the RBI, taking over the regulations, it's exactly the same. There is no difference at all.
So what have they changed then?
No, I'll tell you what. There is no change as such, but it is basically aligning these, standard asset provisioning across the layered NBFCs. See, right now there is a separate one for NBFCs, which is, there is a 0.4% general standard asset provisioning for NBFCs. Okay, it doesn't distinguish between, say, a commercial real estate or a, teaser loan and things like that. Okay. So whereas for housing finance companies, it was always differentiated across housing loans, commercial real estate, teaser loans 2%, and if it is a commercial real estate for housing, it was 0.75 and all that. So that continues to be the same. As far as housing finance companies are concerned, it's exactly the ditto same as it was
earlier.
There for
So
many
it's
years.
changed only for NBFCs, you're saying?
So because now what has happened is the whole regulations are for NBFCs, including housing finance companies, and within the NBFCs they are now having various layers actually, and across layers they are having different applicable regulations.
Okay.
So this basically aligns the regulations for all NBFCs. Of course, HFCs are always there, and NBFCs are getting aligned to these standard asset provisioning across various
Maybe I'm going to ask you an unfair question. How much of NBFC loans are teaser loans and SME loans? For a typical NBFC, will provisioning go up?
Yeah, teaser loans, I don't think anyone in the system has teaser loans as of now, as far as I remember. There are no teaser loans in the system at all. Now, as far as the other asset classes are concerned, whether it is lending to real estate projects and all that, there will be some which will be there with some of the NBFCs, which are doing some wholesale loans. And for them, the applicable, standard asset provisioning will be higher because today they are governed at 0.4% across all asset classes.
So can we say that commercial real estate or some commercial real estate and some SMEs are going to face higher costs?
I don't know. It all depends. In any case, NBFCs, the lending rates are always different compared to the banks and others. So I don't know how much of difference that will make. But yes, in some sense, the provisioning. And the other thing is that the provisioning which NBFCs follow for their, books of accounts under Ind AS is as per the ECL norms. Okay. Both for stage 1 and stage 2 assets. So the way it happens is that you have to compare the total provisioning which you carry for standard assets under stage 1 and stage 2 and compare it with the regulatory provisioning requirement overall. If there is a shortfall, then you have to provide it through an impairment reserve. That is the current regulation.
Fair enough.
Applicable to everyone. Yeah.
Okay, fair enough. We'll leave it at that, sir. Thank you very much indeed for joining us. My bad. It's not impacting housing finance companies. It's impacting NBFCs. And perhaps the impact will be limited since they may not be lending too much for commercial realty.
Absolutely. And it's on lighter note, it's good to see Rangan on air. Let's welcome in Gurmeet Chadha, Managing Partner and CIO at Complete Circle Consultants. He's joining us right now to talk stock. Gurmeet, great to have you with us here. Thank you very much. Appreciate it. And I mean, first of all, congratulations on the many hires at Complete Circle Consultants that you've been sort of putting the team together. So best of luck with that. Your thoughts, Gurmeet, in terms of where we are. Is it basically wait and see mode to try and pick which is going to be the direction, up or down? I'm talking about near to medium term, because almost a holding pattern if you look at the last few sessions that we've had. Go on.
Yeah, Prashant, and I've been making this point in our previous discussion. There are cases in market where less activity is good. You can possibly tweak a little bit, see what your portfolio is. Let's say if you're overweight on, commodity consumers, if you're overweight on, let's say IT, if you're overweight on, few, let's say specialty chemicals, pharma names, you have to figure out what you need to maybe do a bit of a rebalancing. Bear phases are good to rebalance and not to act much. And I think too many events I think which markets is trying to price, and I think the debate here is how much is negative news in the price. 2 or 3 rate hikes till August, September by Fed. I think that's in the price. Whether they are more hawkish or not, I think that remains to be seen. How much of demand destruction will happen, because monetary policy tools are very blunt, and also this the 10-year yield, both US and domestic. My experience is that around 8% yield, it's neutral to negative for equities, always has been. And that's the time actually to get a little more, maybe more constructive on both sides. So we did a rolling return analysis that even fixed income returns are double digit when the 10-year crosses 8%. So we are nearing that. We are already in that 7.5% range. So there is a lot of, good risk reward in few pockets. And I think, you should use dry powder selectively. And if it is unnerving you, I keep saying, just don't do anything.
Okay. Gurmeet, hi, good morning. I wanted your thoughts on, the rising COVID cases and the impact that it would have on certain businesses, right? For example, diagnostic companies will perhaps do well as testing goes up. In the very near term, after the fall that we've seen in diagnostic companies, does it make sense to buy?
See, I think the market, when sentiment is negative, it tends to react very aggressively. I think just because somebody launched, test at $100, we saw massive erosion. I think this sector is very, very unorganized. In fact, local players, especially in tier 2, tier 3 cities, have 80-85% market share. So I think consolidation will happen. I think just buying something just because COVID tests will go up may not be a great idea. So let's say, for example, Dr. Lal, has almost 1,300 odd centers. They have 3-digit clinical labs. They follow a hub and spoke model. They've been trying to work on a digital presence as well. You can look at integrated players like Apollo, which are both into hospitals, pharmacy, trying to do digital integrators. I like more this API cram space. I think this pharma outsourcing opportunity to me is very big. Next 3 years, you have almost $20 billion of molecules going off patent. And I think this opportunity is huge, and we are seeing significant capex so Divi's, for example, 1,000 crore this year. So the capex it's doing in next 3 years is more than what it has done in 30 years. Corrected 30-40%. You rarely get these kind of corrections in names like Divi's. I think that API cramps, in my view, and obviously you need to track what molecules will get commercialized when, at what stages of development they are in. It's a little technical line. I think that space excites me more in this overall space.
Okay. Gurmeet, good morning. As always, good to have you. One other space that's suddenly become very popular in India are the oil refiners. Those who make end refining products like, Chennai Petro and MRPL. Can you explain to us how to value them? One understands the gist that the cost of their products in the global market has gone up, which we call higher refining margins. But how much value can you give them?
You're right, Lata. These are best tactical plays because the Singapore benchmark refining margins are up. We've been tracking diesel spreads and all. So complex refiners like Reliance tend to gain more because they have the ability to recalibrate. There's been also news of Russian crude being heavier, and refineries are being realigned to process more of that. I think a better way to play this is to play the energy basket, in my view. I think the energy basket is changing, and I think India will have a more hybrid model. You should have, somebody like a Reliance, which plays, obviously this near upsurge in refining as well as the entire hydrogen solar play. 1 lakh crore kind of capex, almost 11 companies acquired. So they're trying to do a geo in energy as well. You can get into something like, let's say, a Tata Power, great turnaround happening, 25 gigawatt clean energy portfolio, till 2025, leaders in EV charging, a great order book on solar EPC as well. So, transformation from a traditional power generation and distribution player to, a clean energy player. You have, some of the ethanol plays, right, with government, expediting the ethanol blending. I think they're already almost 10% there. Will hit maybe 20% in next 2 or 3 years. So I think a basket approach on energy on a structural way is far better. We don't know what will rule. What model will eventually emerge. So maybe EV for urban and maybe ethanol towards hybrid model towards rural. Mind you, the government also wants 60 rupees a litre. On crude. So it's not going to be easy and, all green. And so it will be more long run. So a basket approach is better.
Okay. Gurmeet, many more questions for you, but do stay on. We'll come back to you in just a couple of minutes from now. The big event is upon us. The 3-day meeting of the Monetary Policy Committee kicked off on Monday, that's yesterday, and a rate hike seems imminent.